All right, let's go ahead and get started. Again, everyone, thanks for joining today. My name's Nathan Davis. I'm the partner here at Aspen, as well as our Chief Investment Officer. And it's excited to talk about this past quarter. It's kind of funny if if we just looked out and said, "Hey, January 1st versus where we are today," you would kind of expect for us to have had a pretty boring year overall. I think as of market close yesterday, S&P 500 was up about 4% for the year. That is, when all is said and done, a pretty normal start to the year. But as you get down to the day to day and the month to month, it was definitely far from a boring, stable quarter. So we'll talk through, some of what happened in the first quarter, kind of the interesting development of, hey, a lot of this data is as of 3/31. But all it takes is 2 to 3 weeks past that date, and things look pretty different. We'll talk about that as well. But I think overall, as we think about that, the first quarter of 2026, it was a period where markets were really tested across several fronts. So we saw meaningful geopolitical escalation, obviously, particularly involving Iran, which pushed oil prices higher. It reintroduced some of the uncertainty around inflation. So we'll talk about what that did for markets, the return of geopolitical influence. At the same time, you take everything that the Federal Reserve has been looking to as it pertains to inflation and economic data. And those expectations for the Federal Reserve really began to shift through the escalation of this conflict. Coming into this year, markets overall were anticipating a pretty clear path forward toward rate cuts. It wasn't like if rates were going to be cut, it was how much and how soon. And now that narrative has changed a little bit over the course of the quarter. Overall, that outlook became less certain. So in a relatively short window, we had a combination of geopolitical risk, higher energy prices, changing interest rate expectations, and all of those things historically create challenges for markets, and they very much did for parts of the first quarter as well. So what's notable is that despite these developments, all of these changes, markets remained relatively resilient, as I said, as of market close yesterday and where we stand today. And so for me, that's really the key theme for the quarter. It's not that, risks disappeared, but it's that markets were able to absorb those risks without a meaningful deterioration in our underlying conditions. The underlying conditions, which were as amazing as it seems that we've had a, economic expansion and a bull run for as long as we have. The underlying conditions, really had been quite positive heading into this quarter. So what we'll focus on today, it's not just what happened, but it's how markets responded, and what that may tell us about the environment going forward. As always, we will try and close with an actionable summary. As investors, what are the implications of everything we discussed today? What does that mean for your asset allocation? What does that mean for portfolio management considerations? What do we do with all of this information that the market and the news cycle provides to us? We'll try and tie it all together of like what this means for us. So starting with just the actual specifics of market returns themselves. So first quarter, it was defined less by smooth returns and more by how markets handled a pretty complex geopolitical environment. So we saw an increase in volatility at various points during the quarter. There were highs, there were lows. It was largely tied to geopolitical developments, shifting expectations around interest rates. As of March 31st, most major asset classes were modestly negative. U.S. equities were down just about 4%. International developed was down 1%. Emerging markets were down 17 basis points. They were relatively flat, with global real estate being the one bright point of the quarter, up 77 basis points. That's been a long time coming. Global real estate has, similar to bonds, had really been lagging for the last 5 years or so. So on the surface, this was a quarter where returns were relatively muted. They were weaker across the board. But I do want to emphasize that these numbers are as of quarter end. And since then, we've actually seen a meaningful recovery in equity markets, particularly in the US. So markets are moving back toward and keep bouncing off of like, all-time highs recently. So the contrast is important because it reinforces a pattern we've seen repeatedly, which is that markets can move lower fairly quickly in response to new information, but they also tend to recover before there's full clarity around the situation. Zooming out just a little bit from a time frame perspective, looking at our long-term market summary here, it's worth pointing out that even though we had a difficult quarter, January 1st to March 31st, it still fell well within the normal range of outcomes for markets. And negative quarters are a regular part of investing. They're not an exception. When we look at the long term, over the last 12 months ending March 31st, even with that drawdown to start the year, the US stock market was up 18%. International developed stocks were up 23%. Emerging market stocks were up 29.5%. And this is all including the period of drawdown that we saw to start the year. So an important reminder that even strong years include volatility. Every year includes volatility when you're talking about the stock market. So, before we move into what drove markets this quarter, we'll zoom out for a moment. We'll put what we just saw into context. What this chart here looks at is market behavior over time, and it shows something that's easy to forget in the moment when we're tracking those day-to-day drops in the U.S. stock market, the global stock market, and that's volatility is a very normal part of investing, even in years that ultimately end up positive. If you took all of these red dots here, which are intra-year declines, so a relative bottom of markets in any given January 1st, December 31st calendar year, on average, markets experience intra-year declines of 10 to 15% per year. Many cases, it's even more than that. You see some of these outlier examples. In 2008, markets ended up down 38%, but at one point they were down 49%. We see years like 2020, where markets were down 34% in 3 weeks at the onset of the pandemic. But when all was said and done, January 1st to December 31st, the market returned 16% in 2020. So what we see here is that on average, there are intra-year declines of some relative peak to some relative bottom around 10 to 15%. And despite those declines, markets still finish positive in the majority of years. I think this is particularly important after a quarter like this one, which we just experienced, where returns were modestly negative, volatility picked up, because what it reinforces is that what we're seeing is not unusual by any means. It's part of the normal pattern of how markets behave. In many cases, these periods of volatility are just the price we pay for longer term returns. When we talk about our diversified portfolios that we have for our clients and our investors, which we will touch on a little bit more as we talk about implications near the end. But this is kind of the price of admission for the long-term higher expected returns that we plan to have by participating in stock markets. The price of admission is the intra-year volatility. And yes, if we have $100 invested in stock, there's a very real possibility that 6 months from now that $100 is 50. And we always want to be mindful of that as we're determining our asset allocations overall for our portfolio. So building on that market backdrop, the natural next question is what exactly drove returns during the quarter? When we step back and we simplify it, most of the movement we saw can be traced back to a fairly tight chain of events. It started with geopolitical escalation, particularly involving Iran. As that situation developed, it created concern around global energy supply and stability in the region. So that led to a move higher in oil prices. It was one thing after the other as a sequence of events, the move higher in oil prices, that's often the most immediate way that geopolitical risk feeds into financial markets. From there, higher oil prices began to influence inflation expectations. even if the impact is temporary, energy tends to show up quickly in inflation data. And we'll look at kind of the components of inflation data here soon. Overall, it can shift how markets think about the path forward. As inflation expectations moved higher, had a direct effect on how investors were thinking about the Federal Reserve. Expectations for rate cuts became less certain. And in some cases, those expectations were pushed further out considerably to say, hey, maybe the Fed is content with keeping rates higher for longer, given this recent bout of inflation. All of those expectations worked their way through markets. So in a relatively short period of time, markets had to adjust to a new set of assumptions around inflation and interest rates. That sequence, geopolitics to oil, oil to inflation, inflation to Fed expectations, that's really the key framework for understanding most of what we saw during the quarter. The sequence of events that started with geopolitics, it ended with volatility in markets. That is what kind of got us into the sequence of events overall. So expanding on that, geopolitics was our initial catalyst for much of what we saw in the quarter, as you said. With tensions escalating involving Iran, the primary concern from a market perspective, it wasn't necessarily the conflict itself, but it's more so how it could affect global energy supply and transportation. So in looking at that chain of events and kind of going step by step to say like, well, what actually caused us to get from point A to point Z? Historically, it's been that kind of key transmission mechanism, the supply of oil. So geopolitical events tend to matter most for the markets when they influence oil. We saw a similar story at the onset of Russia's invasion of Ukraine. And that's exactly what has happened here. Oil prices moved higher as markets began to price in the possibility of supply disruptions, and then just broader instability in the region. From there, the next step is fairly straightforward. When higher oil prices feed into higher near-term inflation expectations, particularly through gasoline and energy-related costs, what's notable, though, is that the overall market reaction really remained relatively measured. I'm sure for many people, it didn't feel measured or moderate when you're watching 2-3% swings in the market in any given day. And we very much saw some of that short-term volatility, but it was not the kind of sustained drawdown that you might have expected if markets believed that this would be an event that significantly disrupts global growth overall. I think that it's an important distinction. Markets were clearly paying attention to the risk, but they weren't treating it as something that fundamentally changes the trajectory of our economy overall. Building on that, just kind of connecting the full chain of how these developments actually flowed through markets. As oil prices moved higher, the most immediate impact was on inflation expectations. Energy tends to show up quickly in inflation data, particularly through gasoline and transportation-related costs. So even if these effects are temporary, markets generally don't wait to see how long they last. They adjust expectations in real time. That shift in inflation expectations then feeds directly into how investors think about the Federal Reserve. Earlier in the year, there was a fairly strong consensus that the Fed would begin cutting rates in a steady and a predictable way. But as those inflation concerns picked up, that timeline became considerably less certain. So in some cases, expectations for rate cuts were pushed further out. In others, investors began to question whether cuts would happen at all in the near term. So it was a pretty significant shift in expectations for the path of rates and all of the impacts that those rates have in other areas of markets in our economy. The change in expectations is what we saw reflected when we talk about the volatility of both bond yields, which I would say it was probably the larger surprise for some of our investors of the volatility in bond yields, with the exception of very few years, one of which was kind of recent in 2022, Bonds tend to not surprise us very much, but we very much saw volatility in bond yields as well as the stock market, equity market volatility overall. So when we think about what drove markets this quarter, it wasn't just the geopolitical event itself. It was how that event influenced oil, how oil influenced inflation expectations, and then how those expectations ultimately influenced interest rates. So put some data behind what we just discussed. This chart shows the movement in oil prices during the quarter on the far right-hand side, as well as over the last 20 years. It's pretty typical to see volatility in oil markets, just like we expect to see volatility in the stock market. But you can see that prices moved higher very quickly. On the right-hand side of our chart here, it's an immediate spike of close to $50 a barrel. That was almost an 80% increase overall. So particularly as those geopolitical tensions increased, and markets began to assess the potential for supply disruptions. So this is a good example of how markets tend to react in real time. Even the possibility of a disruption, it doesn't even need to wait to see an actual disruption, just the possibility of one can move prices. So as we discussed on our previous slide, this move in oil doesn't stay contained within the energy market because the energy market feeds into so many other areas of our economy. It feeds directly into those inflation expectations in the near term. And that's where the broader market impact comes from, is those near-term inflation expectations. It can also begin to affect consumers more directly, as any of us that don't drive electric cars can find out quick, especially through gasoline, transportation costs, and it puts pressure on spending margins for consumers. So what's important to keep in mind, though, is that while these moves can be sharp, they don't always translate into a long-term economic disruption. It is pretty common that when oil prices eventually do fall, it is unfortunately rarely as quick as they rise. But we're confident we'll see some sort of correction, and you saw some of it pretty quick here, just through the month to date, if you will. But it rarely falls as quickly as it rose. But it does seem like this short-term move doesn't always translate into a long-term economic disruption. All right, so stepping back from oil specifically, it is helpful to look at inflation more broadly. So while inflation has come down meaningfully from its peak levels, back in 2022, inflation was as high as 9%. While it's come down meaningfully from its peak levels, it still does remain above the Federal Reserve's long-term target. So what's changed more recently is not necessarily the overall level, but it's what's driving it. Of course, energy is now contributing more than it has in quite a long time. We'll see that on our next slide when we look more at the actual components of inflation. At the same time, services inflation, which tends to be more persistent, it's tied to wages, it's tied to housing, it has remained relatively elevated and slower to adjust. So if you talk about kind of the 2+ year picture of our overall inflation rate not getting quite as low as the Fed would like to see, it's largely the services inflation component that has been guilty there. On the other hand, goods inflation has generally stabilized. Supply chains have normalized. That was a lot of the transitory part of the inflation we saw during the pandemic. Supply chains were interrupted, manufacturing had slowed. The goods inflation we have seen largely come and then go, and that has been one of the positive components of inflation. So rather than thinking about inflation as a single number, it's more useful to think about it as a combination of different components, each moving at a different pace. And then importantly, it's that evolving mix that continues to guide Federal Reserve policy. This chart here, it breaks inflation down into its underlying components, which helps give a clearer picture of what's actually driving the overall number. As you can see on the very far right of this chart, With green being our energy costs, it was a large contributor to inflation. 2021 through, call it end of 2022. That's our energy. We actually saw energy prices falling for a stretch of time through 23, 24, and we are just now seeing another large contribution to overall core CPI with our inflation component. But one of the key takeaways here is that inflation isn't moving uniformly across categories. Energy is, with a sharp increase, is contributing more now than it has. It's safe to say more than it has in about 2+ years. Services inflation, as we said, it tends to move more slowly. It's often tied to wages and housing. That has largely stabilized. I do think that is what we will continue to see, a drop in over time as we work towards the Fed's headline inflation number that they would like to see for them to be comfortable with reducing rates again. Goods inflation has not spiked yet. There can be a lag effect on goods inflation with the impact that energy as an input costs can have on some of those goods. That still remains to be seen. But overall, when markets react to an inflation report, they're not just reacting to the headline number. They also look at what's driving it under the surface. From a policy standpoint, the Federal Reserve is very much doing the same thing. So with that inflation backdrop in mind, we can now look at how expectations for the Federal Reserve have evolved. Coming into the year, there was a fairly strong consensus that the Fed would begin a steady path of rate cuts. Over the course of the quarter, that confidence began to shift as oil prices moved higher and inflation expectations became less certain. Markets started to reassess how quickly the Fed would be able to ease policy. So in practical terms, that meant that expectations for rate cuts were pushed further out. It's important to note, that the Fed hasn't fundamentally changed its longer term objective. The Fed as an institution tends to be pretty patient. If market participants react suddenly to a spike in oil prices like we saw, one institution that is not likely to react quickly or without a great deal of thought is the Federal Reserve. And so fundamentally, it hasn't changed its longer term objective. In the near term, what they have signaled to us is that they've become more cautious and they've been more dependent on incoming data. So that shift from a more predictable path to a more uncertain one, particularly as it pertains to our yield volatility in bond markets, that is what we have seen reflected in markets. A slight shift away from a predictable path to one that becomes a little bit more uncertain. So this chart overall, it helps to illustrate the shift in interest rate expectations that we just discussed. Earlier in the year, markets were pricing in a relatively steady path of rate cuts. As the quarter progressed, and particularly as inflation uncertainty increased, those expectations began to change. You can see here on the right side of our graph where it shows, hey, what is the market expecting for cuts? What is the FOMC, the Open Market Committee for the Federal Reserve, expecting for their rate cuts? Some of the changes that we have seen. And it's not, what's important here, it's not necessarily the exact number of cuts that are being priced in, but the change in expectations of when they'll begin. Markets tend to react more to changes in the outlook than the absolute level of rates themselves. And it's why, as we've seen, either the Fed systematically raising rates or cutting rates over time, it's never quite so perfect that the day of the meeting and the day they announce their rate increase or their in 22 or their rate cut that we have seen recently, it is not the announcement comes and there's an immediate change in rates across the board. Everything has already been priced in as it pertains to those market participant expectations. And so that's where the markets tend to react more to changes in the outlook than what the absolute level of rates are themselves. So overall, the volatility that we saw in equities and fixed income, it's the change in market expectations for rate cuts uh, that was driving a lot of the volatility. So, after walking through some of the shorter term drivers of market volatility, um, it's helpful to step back and look at the broader economic picture. Overall, growth continues, but at a more moderate pace. Consumer spending remains relatively stable, which continues to be a key component for the economy. People, especially Americans, are always going to find a way to spend money. I like to say, never underestimate the general American's propensity to consume. Americans love spending money. That has very much persisted. At the same time, some areas, particularly housing, have remained constrained by the higher interest rates. On the positive side, so business investment continues to provide support, particularly in areas like infrastructure, technology, and so when you put it all together, the economy isn't accelerating, but it's also not showing signs of broad deterioration either. It's slower, but it's still stable, and it is still technically an expansion. And so this chart helps to illustrate that trend more clearly. What we're seeing is that growth has very much moderated from earlier levels, but it does remain positive overall. And that distinction is important because markets behave very differently in an environment of slowing growth versus one of outright contraction. Right now, the data continues to point towards moderation, not necessarily pointing us towards a recession. And so that's a key part of why markets have been able to remain relatively resilient despite the uncertainties we've discussed, because at its foundation, our economic data is still good. We are in a very late stage of an expansion, and it is signaling time for a change in the future. But with where we are today, the data does not signal a tip into outright contraction or recession. It is just moderation, meaning that we are growing, but that growth seems to very much have slowed. Taking all of that and kind of making our first shift into asset class discussion. So turning to fixed income, this is one of the more meaningful changes we've seen in the current environment compared to the past decade. So much of the post-financial crisis period, bond yields were very low. It limited both income and expected returns. We have a slide, two ahead for now. We'll kind of digest that a little bit more. But today that's no longer the case. Yields remain meaningfully higher, which provides a stronger foundation for fixed income overall. And that higher starting point is important because it tends to be one of the best indicators of future bond returns. At the same time, bond prices are still sensitive to changes in interest rate expectations. They are sensitive to it, but they are less sensitive than they would be otherwise when you're starting with a much lower baseline interest rate. And so when markets reassess the timing or the pace of Fed policy, as we saw this quarter, yields can move higher, which creates short-term pressure on those bond prices. As we had a very real reminder of in 2022, as yields move higher, bond prices move down. The market expectations, as we've discussed, have kind of been the opposite of that for the year. The expectation was that yields would be moving lower, and when yields move lower, prices move up. And so just a kind of an opposite effect that we saw with some of our rate volatility for the start of the year. And so the experience in fixed income during the quarter, it may not have felt particularly stable, but the underlying environment is still much improved compared to where we were just a few years ago when rates were zero, prior to the Fed's interest rate increasing campaign from 2022. And so this chart, it provides some important longer term context around interest rates. I will say you'll notice here that this is using an inflation rate of 2.6%. Looking at the data that goes into this, it uses like a longer term average of energy prices. So this past quarter significant increase we saw in energy prices, the inflation used here kind of smooths that out a little bit. So it's using an inflation rate of 2.6%, closer to where we had been on average the past couple of quarters. But so this chart provides some important longer term context around interest rates. So what it shows is that both nominal yields and real yields, meaning yields after adjusting for inflation, um, over a much longer time period. So for much of the post-financial crisis period, looking at, kind of middle of our chart and to the right, 2009 through 2012, 15, much of the post-financial crisis period, real yields were extremely low, and at times they were even negative, particularly as you head into the pandemic and then interest rates rising through 21, 2022. You see the period of dropping below that 0% line with our dark gray line graph of real yields, even at times turning negative. It made it very difficult for fixed income to generate meaningful real returns. We still owned fixed income in our portfolios. This also just kind of takes 10-year treasury yields. Not a lot of individual investors have a true on average 10-year bond exposure as part of their portfolios. Their exposure tends to be a little bit shorter. Maybe it's 5 years on average, knowing that you have some money markets, you have short-term bonds, and the shorter term you were, the less negatively impacted you were by some of this. So looking at, we have seen periods that were very difficult for fixed income to generate meaningful returns. And today that environment has changed. So real yields are now positive again. After a few years in the wilderness of waiting for those higher rates to work their way through our portfolio. And nominal yields are meaningfully higher than they were for much of the last decade. Looking at 4.26% nominal yields on the 10-year treasury. So that shift is important because it means that bonds are once again offering a combination of income and real return potential. So while the short-term experience in bonds may still involve some volatility, the underlying foundation is overall much stronger. This chart helps highlight one of the most consistent relationships in fixed income I alluded to a few slides ago. And this is looking at higher starting yields and how they improve future returns. It highlights one of the most consistent relationships in fixed income. Historically, the starting yield on a bond portfolio has been one of the strongest predictors of the returns investors will ultimately earn over time. When yields are low, future returns tend to be low. When yields are higher, future returns tend to improve. And that's the environment that we're in today. Looking at right here in the middle of our green, we have a current yield of just at 4.46%, a forward 5-year return of 4.47%. That forward return includes considerations for some of the expectations for the path of rates going forward that we talked about in previous slides. And so while short-term movements in bond prices can still occur, the longer-term return outlook for fixed income is much more constructive than we had seen in quite some time. Where you don't want to be on this graph is the lower left, and almost the entirety of the 2010s and 2020s lives on the lower left of this graph. Interest rates were at any point in time where they were rising in the 2020s, you were seeing a strain on your portfolio returns. In periods of the 2010s when rates were getting close to zero and your reinvestment in any interest that you earned was getting lower and lower, it was leading to lower returns over time. With the baseline rates of where we're starting today, we are in a much more comfortable place. So one of the kind of transitioning now back to our equities, one of the most common concerns we're hearing right now is around valuations, and it's absolutely a fair question. If you look at U.S. equities today, valuations are clearly above long-term averages. And that's not something that we're dismissing or ignoring, but the more important question is how elevated are they and whether they resemble past periods of excess. When we look at that in context, today's valuations are meaningfully lower than what we saw during periods like the late 1990s, with that kind of peak right before the bubble burst on the dot-com era, March 24th, 2000. It's pretty near the far left of our graph here. And so while they're elevated, they're not at the kind of extremes typically associated with bubbles. It's also important to consider what's supporting these valuations. There are acceptable valuation expansions and there are unacceptable valuation expansions. Corporate earnings have, through all of this, remained strong, and many of the largest companies today are highly profitable. And they, every single quarter that goes by with these large companies, the expectations from investors in terms of their earnings and their top line revenues, expectations get higher and higher. And somehow, some way, they keep meeting all of those expectations. And so the way we think about this, it's not that valuations are a red flag, but they are a factor that may influence longer term return expectations. And looking at that, so the another important piece of the valuation discussion, it's understanding where those elevated valuations are actually coming from. When we look at the overall market, a significant portion of that valuation premium is concentrated in a relatively small group of large companies. Small meaning it's only 10 of them, not small in terms of the portion of the U.S. stock market or the S&P 500, because those 10 companies are now just about 40% of total market cap of the S&P 500. And so these companies have driven a meaningful portion of market returns and now represent a larger share of the overall index than they have historically. So when we say that the market is expensive, what we're often really saying is that a specific segment, well, absolutely a large segment, percentage-wise, that it's just a segment of the market that is expensive outside of that group. So even if you zoomed out beyond just the S&P 500, S&P 500 is still only the 500 largest companies in the United States. There are approximately 2,500 other companies in the entire US market. Outside of that group of 10, valuations across the broader market are generally more moderate. And that distinction is important because it changes how we think about risk. It's less about broad market excess and it's more about concentration and dispersion. And we will kind of tie a bow on all of that as we get to our implications for investors with portfolio considerations. But this chart, what it looks at is the relationship between valuations and future return expectations. So while valuations can have some relationship with returns over a longer time period, that relationship is much weaker over shorter term horizons. And so looking at left compared to right, when you look at our kind of averages that we see, and then the dispersion of our dot plots, we have seen environments where the forward price to earnings ratio is 23 times earnings, 24 times earnings, which is considerably higher than we are today. And even though valuations were that elevated, you fast forward 12 months and you still earned 40% in your stock market. We've seen time periods where forward valuation multiples were in the low teens, even 11, 12, 13%, and forward returns were as low as minus 40. And so over the course of 12 months in the short term, it becomes considerably less predictable of what is going to happen next as you hit various valuation multiples. As we get on looking forward from today, forward 5 years, that dispersion tightens quite a bit. And where we take comfort in a graph like this is that, yes, absolutely, there have been periods of time where the stock market fails to provide a positive return over a 5-year period. On the right-hand side of our chart, where you see the zero line and any of those dot plots that fall below it, those are rolling 5-year periods where you still failed to receive a positive return in the US stock market. But you can also see that they are by no means concentrated only on the higher end of the valuation spectrum. And so, what we can take from all of this is that, valuations are not a reliable timing tool. We don't feel that there are any reliable timing tools, but absolutely not valuations. They can remain elevated for valuations can remain elevated for extended periods, and while they may influence long-term return expectations, we can almost take comfort in that there is no use in attempting to take these valuation metrics and predict what markets will do in the near term. We own stocks for the long term. Even 5 years is still short term. We expect any distributions off of our portfolios within the next 5 years to comfortably come from the bond part of our portfolio, which we already looked at a few slides ago, that we feel with where the market environment is today for fixed income, the next 5 years looks very promising. And it's exactly the interplay between these two asset classes that is important for us when we make those asset allocation decisions. So, kind of stepping back, pulling all of this together, I think that there are a few key messages that markets are sending right now. First, markets have absorbed what was a meaningful macro shock this quarter. Second, economic growth remains intact, although it is at a slower pace. Third, inflation continues to be the key variable driving both policy and market expectations. And then finally, the path for monetary policy has become less certain in the near term, but it, in our opinion, has not had an impact on the long term yet. That still remains to be seen. So overall, this is an environment that's more nuanced and it's more dependent on incoming data than maybe what we have seen in the past. And so when we think about what all of this means from an investment perspective, there are a few principles that continue to hold true. First, volatility is a very normal part of investing. We looked at that with our chart of intra-year declines and then ultimate calendar year returns. Volatility is normal and it is expected, particularly in the equity part of our portfolios. Second, markets tend to move ahead of clarity. Whenever we see interruptions, we see uncertainty, we see very quick responses to it. And we tend to see some improvement in that volatility prior to a resolution or full clarity of the circumstances that led to our volatility to begin with. The supply shock we have right now, the ongoing conflict in Iran, we tend to see an improvement in markets prior to true clarity on a resolution. Third, short-term uncertainty does not change the long-term drivers of returns. We're not going to try and use the predictive power of data, particularly as it pertains to markets, to change what our allocations are. We are going to participate in markets for the long term with our long-term goals in mind. And then finally, discipline remains the most important factor. You create a sound investment strategy on day one for the purpose of knowing exactly how to respond when uncertainty arises, when geopolitical risks that you hoped to never see again inevitably come back up. And we create that strategy on day one so that we can remain disciplined towards that strategy as uncertainty unfolds, because there will always be some new form of uncertainty for markets. From a portfolio perspective, this environment reinforces a few important themes. Diversification remains critical. We talked about if we wanted to say, hey, what's the potential range of outcomes for the next 5 years, given where markets are and valuations are today in both bonds or fixed income markets, equities and stocks, and you could see that it potentially tells a little bit of a different story. We are in what I think is very sound footing for fixed income going forward the next 5 years. And while it's not that I don't think that we are in good shape from a stock market perspective, absolutely there's the chances of heightened volatility over the next 5 years. Having both of those asset classes in your portfolio remaining diversified is absolutely critical. Based off of where we stand in markets today and always. Fixed income is playing a meaningful role in our portfolios again. On the equity side, the returns may be more dependent on earnings growth rather than valuation expansion. And that's when, all is said and done, if one day in hindsight we could look back and acknowledge that we were not in a bubble through all of this, it largely requires those earnings growth to continue. And that's what allows markets to continue to go up over time at the same valuation multiples. And it's because it's still a function of a multiple of earnings. We want to see that earnings growth continue. And then overall, maintaining balance within the portfolio becomes even more important in an environment where the path forward is less certain. To close, I think the main takeaway from this quarter is that markets proved to be more resilient than the headlines might have suggested. We saw a meaningful combination of risks, and yet markets were able to absorb those developments without a broader breakdown. And that doesn't mean that risks are gone. It simply means that the underlying foundation remains intact. For investors, that reinforces a consistent message. Maintaining discipline through periods of uncertainty continues to be one of the most important factors in achieving long-term outcomes. So that's it for our presentation today. We appreciate you joining us. Here's more information on us. Like everything we talked about today is very general as it pertains to financial planning, as it pertains to portfolio management. You shouldn't take the general. It's very much specific and unique to you and your own circumstances. And we are very much here to help. So here's how you can reach us if there's any questions. We do always record these webinars. We distribute that after the recording is available. So feel free to share. And again, if there's anyone who's important to you, they're important to us. We are happy to help. Here's how anyone can reach our office with any specific questions that may have come up from our conversation today.
Yeah, thanks, Nathan. This has been one of the more highly anticipated updates with everything going on geopolitically and all the recent volatility, but also the rebound we've been experiencing and underlying economic positive tailwinds. So everyone's been eager to hear your thoughts. Appreciate that. And now we'll open it up to Q&A. Usually we don't get too many questions, but just like Nathan said, if you have any offline where Nathan and I, along with the rest of the Aspen team, are here to help. And just also, like Nathan said, people that you care about, happy to talk with them as well and be a sounding board. So wait a second.
That's all right. Well, everyone, thanks for joining us today. If you think of anything after the fact, don't hesitate to call or email. We are here to help.